pleased to have with us a partner in GSO Capital Partners, Mr. Doug Ostrover, who addressed us in an executive session, so I won't reintroduce him to the commission, but to the public, I'll say welcome and thank you for taking the time to come down here and talk to us.
Well, thanks for having me, and welcome, everyone. For the commission, this first slide is going to be a bit repetitive, but for those who I haven't met or had the chance to talk to, I thought I'd give you just a brief overview about who GSO is and what we do. The firm GSO was founded by myself and two partners, Bennett Goodman and Trip Smith. That's the G, the S, and the O. The three of us, before founding GSO, we managed the leverage finance business of Credit Suisse and a firm called Donaldson, Lufkin, Jenrette before that. Leverage finance just is a fancy term of below investment grade junk bonds and levered loans. Just sounds a lot better. The best way to think about what we do today is we are the credit arm of Blackstone. So the buyout firm Blackstone, we oversee all of their bond and secured loan activities. We oversee about $60 billion in assets. We focus exclusively on below investment grade corporate credit, not playing in structured products or commodities or things like that. We're a top quartile performer in all of our strategies, and we emphasize risk-adjusted returns and downside protection. This is a quick snapshot of our business. You'll see up top, as I mentioned earlier, about $63 billion in assets we oversee. Again, it's corporate credit. We believe we are one of the largest managers of below investment grade corporate credit in the world, and we are pretty certain we are the largest non-bank lender in Europe today. Non-bank lender. And I'm going to spend some time talking about Europe. You can see at the bottom we have about 250 employees. We're in New York, London, Dublin, and we're in Houston, Texas. We do quite a bit of investing and loans in the energy space. So that's just a little bit about the firm. What I'd like to do now is shift our attention and talk a little bit about the markets. And when you think about the markets and what we do every day, literally every day we come in and we ask ourselves, where do we go from here? And you know, as I was pulling the slide together and thinking about where do we go from here, I decided to look back at some older presentations from 2009 and 2010. And I was really surprised to see that a lot of the headwinds that we face today are very similar to what we were talking about in 2009 and 2010. In the U.S., we still have greater than 7% unemployment. We have record deficits looming. We still have a debt ceiling debate. We have a political system, I think that many of us would agree is broken. In Europe, there's still a sovereign debt crisis. We have high unemployment, high debt to GDP throughout Southern Europe. I didn't put it on here, but the European banks, I could show you a slide, are still incredibly weak. We're still facing problems in the Middle East, so our concerns about Iran, Egypt, Syria, and we're still talking about concerns about what's happening in the emerging markets, places like China and Brazil. And so what it made me realize is a lot of the problems we face globally are really long-term problems. There is no simple solution. And because these problems are long-term in nature, all of us should expect volatility to remain high. So there are going to be times like today where the stock markets are soaring and volatility will be very low. But I promise there will be times like the summer of 2011 when the U.S. was downgraded and we were worried about contagion from the sovereign debt crisis, where volatility will spike and markets will trade dramatically lower. And so throughout my presentation today, one of the themes I'm going to stress is that now is a time for caution. So as I mentioned, we are fixed income investors. And what I wanted to do is lay out for you some of the options you have as fixed income investors. I can tell you a lot of them are not very exciting. You can buy treasuries, short treasuries, and earn almost zero. You can buy the 10-year at a 270. You can play in investment grade debt, which is above double B, so triple B and higher, and make 2 to 3. And if you're willing to go out much further on the On the maturity spectrum, you can maybe earn 4 or 5. We're going to talk a lot about senior secured floating rate loans because that's an area we like. High yield bonds, 6.5 to 7.5. We'll spend some time on that. That is an area we don't like. And then some of the alternative strategies, and we just took a best guess down below. The one thing you should keep in mind is this bottom right here. And that is, if rates move higher, if rates move 100 basis points higher on a 10-year security, theoretically, you should lose 8%. So rates are something we will be spending some time on. So let's start by taking a look at what's going on in the high-yield market. So over here on my right is what we call our leveraged loans. And this is the index. You can see where they're trading. And on my left is the high-yield market. Levered loans, they trade as a spread off of LIBOR. They are floating rate. My eyes are bad, but it looks like their historical average is LIBOR plus 454, and they're trading at close to LIBOR plus 500. So you might say that they're fairly priced today, or maybe they even have a little value, whereas in high yield historical average is treasuries plus 587, and today it's trading at 463 through this bar, so you'd say those are probably fully priced. The thing to keep in mind, though, is that LIBOR and treasuries are trading at very low rates. And so what that means is that even though we could say some of these securities are fairly priced as a spread basis, on an absolute yield, what's interesting is high yield single Bs and double Bs are trading at their lowest yields, this is as far as my data went back, in 25 years. So it's hard to get excited when you have something trading at those kind of yields. The same is true in investment grade. Now, that's not the markets I play in, but the investment grade market, you can see 4% for triple Bs, 260 for double As. Again, trading at the lowest yields we've seen in 25 years. So this is a very important slide. And this is a slide that I think everyone should keep in mind. I'm 51 years old, and I started working in the fixed income market in 1984. So I think rates were around 14%. And I've been blessed, I think, for a lot of reasons, but in my career, I've been blessed because I went into fixed income in 1984. For 30 years, all interest rates have done is go down. And any of us who have been involved in this market, you have a tendency to be net long, you benefit a lot as these rates go down. The issue is this chart. In May of 13, we were trading around a 160, and rates went up to about 270. It was a 65% increase. Now, it was short-lived. We didn't keep going higher from there. We actually came in a little bit. But the question for all of us in the room today is, how do you make money in this environment, assuming this is probably over? And that's something we'll spend some time on. So there have been a lot of changes in the fixed income market since 2008. And I mentioned early on when we were looking at the slide of your options that we don't really like longer duration, high yield bonds. One of the things we're concerned about is money is moving in and out of the market quicker than ever before. So this is what's coming into mutual funds. We have ETFs. Almost 60 billion came into the loan market. You can see in the prior 4 years about 100 billion into high yield. One of the things that keeps us up at night is if rates were to spike higher and this 100 billion were to leave the high yield market, who would be there to support the markets? And it would create a lot of volatility. This is a chart you're not going to see often, but it's very important. And what this shows you is, this blue bar right here is the supply of corporate debt. And you'll notice, since the crisis in 07-08, the supply of corporate debt has gone and approached $9 trillion. The black bar, which has come down sharply, about 80%, is the amount of dealer inventory. And what we have today is a mismatch. Dealers are no longer taking risk, and by dealers I mean the Goldman Sachs, Morgan Stanleys, and all the banks, and yet corporate supply continues to grow. And what happens when you have redemptions from the market and the dealer's not having any capital at risk, they try to make more money by widening out what's known as the bid-ask spread. But I wanted to give you an example of a bond and what happened in the summer of 2011. So as I mentioned early on in my comments, summer of 2011, you'll remember the U.S. was downgraded, fears of contagion from the sovereign debt crisis. Stocks fell 17%. Well, this is a bond, high-yield bond of a company called Harrah's. These are the 10% notes of 2018. They're actually second lien notes. And what's amazing is that this was a fairly boring credit in 2011. Their numbers were in line with expectations. They didn't buy any assets. They didn't sell any assets. Yet because of liquidity concerns in the market, you can see we had a 35-point drop, a 24-point move up, a 20-point move down, a 20-point move up. If I were to take my hand and cover that Harrah's, and I can't reach, in that right-hand corner, and ask you, what does this chart represent? And you didn't know it was fixed income, I think most of you would say, oh, this is an internet stock, or this is, Facebook, or something like that. Yet this is a fixed income, secured, lightly secured piece of paper. It was incredibly volatile. And so when I say it's a time for caution and I expect volatility to be high, I don't have to look back that far. I don't look back to 2001 or 2008. I just have to look back to June through December of 2011. So this gives you an idea of what's going on in the market, and what you can see is we are having record issuance, both in the loan market and in the bond market. Loans are higher than ever before. Now, one of the things that we do at GSO is we closely track the quality of the bonds and loans that are coming to market. And this is kind of interesting. What this tells you is that in the last 4 years, we've had 220 billion of what we call triple C issuers. Those are the weakest credits that can come to market. Prior to the crisis of 2008, there was 136 billion. So we've had an increase of over 50% of what I would deem to be weak issuance. And the reason I bring this up is there's a professor at NYU named Edward Altman, and what he did was he studied the performance of triple Cs from 1971 to 2011, over 40 years. And his research showed that almost 35% of triple Cs default within 3 years. Now, we're in a different environment today, there's lots of liquidity, but you understand why we track triple Cs, because it's really a foreshadow of the next distress cycle. And I'm not saying it's happening in the next year or two, but we are setting ourselves up for it. So with that backdrop and being so negative, what is it we do like? Well, one of the securities we like a lot, even today, are senior secured loans. Why do we like senior secured loans? They're senior in the capital structure, so they're senior to the bonds I was describing. And if they do have problems, you get very high recoveries. But most importantly is the third bullet. These are floating rate securities. They float over LIBOR. Every 3 months, the coupon gets reset. If LIBOR goes higher, these securities, their coupon goes higher. So in a rising interest rate, they do quite well. I want to just give you a quick example of that. So these are 5 examples of 5 times over the last 20 years or so when the Fed increased rates by over 100 basis points. And for today, I'm going to focus just on 1994. From this slide, you can see that in 1994, the Fed raised rates almost 250 basis points. They had 8 successive interest rate increases in 1994. But look at fixed income performance. High-grade bonds had negative returns, high yield was about flat, but senior secured loans were up about 13% in an environment where rates went up 250 basis points. Now, we're not calling for rates to go up anytime soon. In fact, my own personal view is rates probably won't go up next year. But this is something we keep a close eye on, and we think it's a safe place to be. And obviously, I think a lot of the market's agreeing with us when you see so much money flowing into the space. The last area I wanted to mention to you that we think is interesting is what we call direct lending. And the best way, or we have up here, it's called private debt. The best way to think about direct lending is where GSO takes the place of a bank. If you're a company and you go to the bank and you need a loan, whether it's a working capital loan or a subordinated loan, whatever it may be, and that bank won't lend to you, we have found that oftentimes we can come in and do things that the banks can't. And obviously, when you're in a downturn like 2008, 2009, 2010, the banks weren't lending at all, and we were able to put out capital at really good terms. And what I tried to lay out here for you was what we get, or what we expect to get, versus the public markets. So on average, in terms of coupon, when we're making a direct loan to a company, we're hopeful to earn a premium just from coupon of about 500 to 600 basis points. We get fees, sometimes we get to participate in their equity, but I wanted to highlight one thing, which when you look at this page, your eye wouldn't focus on naturally. Covenants. Covenants are very important. That's your downside protection when things go wrong. There's a new phrase in the marketplace. I showed you all of that issuance. It's called covenant light. It's a polite way of saying no covenants. And to give you a quick story of what's going on in the markets, one of the very large underwriters, we were out with them, they were telling us that they do a lot of deals, and the roadshows are on a computer. And you can watch the roadshow, and then if you want to go read the indenture, you have to log on to their website, put in a password, and they know you've been in to read the indenture, because that's the way they track who's really interested in the deal. This is the largest underwriter of high yield. They told us that only 20% of their buyers actually log on and read the covenants. 20%. So what's happening today, our deals are getting done with no covenants. When we make a direct loan, we stress covenants. We want to make sure that if that company does get in trouble, we're insured of getting a high recovery. And the way you ensure that is by having covenant protection. I'm going to wrap up right now, but I did want to just talk briefly about Europe, because we do have a very large presence in Europe. And this chart is kind of interesting. When you think about direct lending, I can't remember if I mentioned it in executive session or here, but the markets have a lot of liquidity, and it's been hard to do a lot of direct loans domestically. But in Europe, it's a different story. And if you look at this, what this shows you is how companies in the United States finance themselves versus companies in Europe. So if you look to the right, you can see there's quite a bit of a blue bar, which is the bond market, and also a bank loan market. So in the U.S., most companies, decent-sized companies, have two sources of funding. They finance, as I mentioned, in the bank loan market and in the bond market. The rest of the chart, when you look at Europe, what that shows you is almost in every country they finance themselves solely with the banks. And I said early on, the banks in Europe are not in great shape. So they only have one source of funding. The issue that's occurring in Europe today is this. When that debt comes due, and you have some foreign banks in a capital structure, so let's say a Spanish company who may have UK or Scandinavian and German banks in their syndicate, and they're either violating a covenant or their debt's coming due, well, naturally the Spanish banks are going to want to support that company. They're going to roll their debt. But the German, UK, Scandinavian banks, they want to pay down. They'd like to get out now. So where is that capital going to come from? We've been able to fill that void, and we've been able to put out billions of dollars in Europe at very attractive terms. And I'll just leave you with one last slide before I conclude. The U.S. markets have been strong. The European markets have been strong, but they're much smaller. And so what we've seen is the European market has grown quite a bit. And so when I say where is that capital going to come from, if you're a big company and you have a brand name, you can come to the public markets. But if you're a mid-cap company, or you're going through a difficult period, then most of those companies come to someone like GSO or someone who looks like us. So I think for the next year or so, this is going to be a very, very large opportunity. So let me just wrap up. Again, these are the things we talked about. We believe now is a time for caution. Markets have had quite a run, both in credit and in the equity markets. As I think I mentioned during my speech, we're not calling for rates to go up anytime soon, but we do think there's going to be a lot of volatility over the next 12 to 24 months. I personally believe that credit will do okay, especially the loan side in 2014. We think investors should start to get out of high yield and rotate into senior loans. And we really are advocating non-correlated strategies like direct lending as a place where you can continue to generate above market returns. So that wraps up my formal comments, and happy to answer any questions.
One question. You told us, and we all, I think, understand the positive aspects of the floating rate securities. Are there any negatives that you see in that? We've seen a tremendous amount of public participation here recently in floaters. But does that concern you at all, A? And B, do you see anything in those securities that concern you?
Yeah, that's a great question, by the way. And the answer is yes. And I see a lot that concerns me. So, I'm talking broad strokes here. Get out of high yield into bank debt. I don't mean that all high yield is bad and all bank loans are good. And you raise a really good point. Just because something is deemed floating rate bank debt doesn't mean it's a good risk reward. So when we talk about senior secured loans, we're looking for loans that have low loan to value, good covenant protection, and a reasonable rate of return. What we're seeing in the public markets today is their spreads are coming down and the loan to value is going up. So just to give you an example, I saw a bank deal come to market the other day. If you think about a typical capital structure, usually if you think about multiples of cash flow, so from 0 to say 3 or 4 turn times cash flow, might be a piece of bank debt and there'd be subordinated debt underneath that. What the investment bank did is they created something they called the unitranche, where everything was just one tranche, and they called it bank debt. So now what you're doing is you're taking bank debt risk on the very top piece, but you're taking subordinated risk on the junior piece, but they call it all bank debt. So to answer your question, the key is, whether it's high yield or bank debt or triple Cs, there will be good issuance and bad issuance. And we're in a period right now where there is excess in the market. So you've got to understand the covenants, and you've got to understand what your downside protection is. Remember, the key to fixed income investing in general, and it goes to direct loans as well, is you're earning a fixed coupon. If you're really right, things can trade to 110. But it's not like owning a stock. It's not going to double or triple in value. And so where you get hurt is when you're wrong and your recoveries are low. And so what we spend the most time on is not how much money are we going to make, but that if that company were to default, if we're wrong in our analysis, what is the recovery? And so specifically to answer your question, I can't give you the exact percent, but I showed you the triple C numbers. I'd say a lot of the bank debt that we see coming in the public markets, we probably wouldn't buy at this point.
But you're touching on some of the points of thinking about other key risks out there. And as we think about investing in high yield versus direct lending, and obviously there's the give up of liquidity. And can you speak to maybe some of the liquidity risk and what the expectations for additional premium would be for that liquidity?
So, what Herschel's referring to is, I had a slide up there on direct lending, and if you think about a direct loan, probably the worst part about it is that it is completely illiquid. We own 100% of it. Usually nobody else knows it's even out there, and if you need that liquidity, you can't get it. So if I'm going to make a private loan, I have to earn a large premium. And I can tell you that today, if we're making a private loan, we expect to earn a minimum of 800 basis points, minimum. So that's almost making about 100% premium. The negative of wanting to make that 100% premium in this environment is it's hard to put out capital. So in a market like we're in today, especially domestically here in the US, we're putting out very little money. Now in Europe, we're able to still earn that, and we'll probably end up doing, a couple $2 billion of originated product in Europe this year. But in the US, it's tough. So we like that trade-off for something like the retirement system where, you're looking out a number of years. If you can compound at that 800 to 1,000 basis point premium, it is really powerful. And so I think, my own personal view is, not just South Carolina, but endowments and retirement systems in general should continue to allocate to that space as long as you're earning that premium. If it starts coming in and gets too narrow, then obviously you're better off being in liquid securities.
I think that's a good point as you think about the liquidity and the longer duration nature of the liabilities themselves. If you can earn twice or more what you would normally get from a bond, then you can afford to take some of that liquidity risk, if you will, with a portion of the assets. And as we've discussed with respect to, I think the key part you're talking about is the private capital or private lending is you're in much more control of those debt covenants. And if something does go wrong, you can step in, and you're senior all the other parts of the capital stack. So our preference and some things we've talked about here is that we are making some of that exchange away from, obviously not divesting completely of the more liquid markets, but we are pulling some of that liquid market exposure off and going into more private debt. So.
Yeah, and I think, as I said earlier, I think that makes a tremendous amount of sense. And ever since 2008, we've been in an environment where the market has put a huge premium on liquidity. And so when everybody is going in one direction, if you can go the other way, you usually get paid, an additional premium for that, and you've benefited from that, and a few others have as well. And that's what's happened over the last 5 years.
You haven't mentioned leverage at all. Do you plan to leverage in any of this work?
We're not big believers in using leverage, and not that, it's, some people do. It's really not how we try to generate our returns. We didn't go into a lot of detail here, but if I can earn on some of these direct loans, if I can earn a 12, 13% yield coupon and buy it at a discount and get called out at a premium, I can have a contractual 15% return, and oftentimes I have equity kickers as well. So we don't really need to use leverage, and I'm not dismissive of leverage. It's just not how we operate our business.
Okay.
Is covenant light a U.S. phenomenon, or are you seeing that in Europe as well?
No, it's a global phenomenon, and hopefully it goes away at some point. Thank you so
Excellent
much.
report. Thank you,
Appreciate
Doug.
it.
Thank you, Doug.